This episode of the Planet MicroCap Podcast is brought to you by Friedman LLP, a top 40 global accounting, tax, and business consulting and advisory firm, providing a full spectrum of services for public and private companies since 1924. Contact Friedman when you will need to raise capital and adhere to U.S. standards. The Friedman partners will work diligently with you to provide the financial assurance, regulatory, and transactional services you need. When the stakes are highest, Friedman makes sure you are well equipped. For more information and to get a Friedman free consultation, please call 856-830-1660 or email Neil Levine at nlevine@friedmanllp.com. Again, for more information and a free consultation, call 856-830-1660 or email Neil Levine at nlevine@friedmanllp.com.
This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. You can follow Planet MicroCap on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. You're listening to episode 176. If you have any questions or comments, please feel free to tweet at me or shoot me an email at rkraft@snnwire.com. And when you do get a chance, if you like what you hear, please rate and review Planet MicroCap on iTunes. It really helps provide feedback for me and spread the MicroCap message. Now, one quick announcement, save the date. We just announced our next virtual conference, the SNN Network Summer Virtual Event, which will be held on August 17 through 19, 2021. The website is now live, and you can find the full details on the event at our website, which is conference.snn.network. Registration is open, so click the register button once you are there. If you register, you'll also be able to get all sorts of information as we update it, speakers, sponsors, presenting companies, the whole deal. So I look forward to seeing you all there. And that's at conference.snn.network. Now, for this episode of the Planet MicroCap Podcast, I spoke with Ben Claremon and Eugene Robin, the principal portfolio manager and principal research analyst, both respectively, at Cove Street Capital. When I chatted with Ben last year for episode 135, he told me about his colleague Eugene, who has some great microcap stories to tell. So I thought it'd be fun to have them both on to chat about all things microcap. Thank you again for tuning in to episode 176 of the Planet MicroCap Podcast, and please enjoy my conversation with Ben Claremon and Eugene Robin. Welcome back, everybody, to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and joining me today are two guests. We got a 2-for-1 special today. Joining me right now is returning guest Ben Claremon and new to the show, Eugene Robin, both from Cove Street Capital. This is going to be your classic microcap. We're going deep into stories, the whole bit. So I want to welcome my guests, guys. Thank you for joining me today. What's going on?
Thanks for having me back. I'm happy to be back.
It's great to have you, man. And Eugene, welcome. You know, you're in the right spot. I like the guitar background. I mean, you're made for podcasting.
This is my designated podcast spot. People keep messaging me like, "Hey, wow, I really love the guitars." And I'm like, "Yeah, not mine, man. Sorry." It's actually our founder and CIO, Jeff. He's a big guitar fan, so he has like probably a dozen in the office, and this room is great, so I usually use it to pretend like I play.
It has happened that during conference calls with companies, Jeff will just start playing, and the management teams will be like, "Is anybody else hear music?" And then
he's like, "No."
Does he have a theme song for each call? It's like, oh, this is a good call, so I'm gonna play this.
It's unclear why he chooses the specific song, but needless to say, we have a slightly informal culture here, and part of our we have 3 goals here: delight clients, have fun, make money, and so we definitely have fun in trying to do the other 2 things.
That's for sure. I mean, that would be pretty hilarious if people are like, wow, okay, this is a signal from Jeff. If he's on the call, he's playing like a blues song. It's like, oh, that's not so good.
You know what?
He's playing like an upbeat. Yeah, he's playing like an upbeat, like Jimi Hendrix or whatever. And wow, okay, all right, this must be a good call.
Yeah, we're gonna mention that to Jeff. Like, he should start every call with like a song that's based on his mood.
That'd be hilarious. All right, so Ben, if you don't mind, I'm going to take 5 minutes because this is Eugene's first time on here. I want to give everybody a little bit of perspective, because we're going to be talking microcap stories and everything, but first things first, Eugene, introduce yourself to our audience. Give us a little bit about your background and why your fascination with microcaps.
Sure. Okay, let's see. Well, once upon a time, I actually had a real job, and unlike everyone else in the office, my degree is technical. I was an English lit major like Jeff. I had a computer science degree. I was a software engineer for actually one of our holdings in our small cap value strategy, Biosat. Went back to school at UCLA and got an MBA there. In the process of doing that, I randomly met a guy who wound up being the son of one of the billionaire families in Kuwait. And just life is really random sometimes. I started working for their family office, and I spent almost 4 years kind of doing everything under the sun. I think when you're in the Tres Comas Club, you have a lot of things that you're involved in. So it gave me a kind of a crash course right after business school, and just general finance and everything from aircraft leasing to fund of funds to hedge funds to direct investments. And, it was odd and strange, and also a great learning opportunity. Then I met Jeff actually through one of the former partners here, Danielle. And started at Cove day one with him and Ben. So we've been here almost 10 years now, which is crazy to think about. It'll be 10 years on June 30th. So time flies. Anyway, and then in terms of your question about why microcap, it's funny. When we first started Cove, we were very small. I think we had maybe 200 million or so in assets. And when you're smaller in the small cap space, I think you can tend to skew smaller in terms of the names, just given the liquidity profile. We had smaller companies that we owned back then, and, saw some of them grow up. And over the next couple of years, I've figured, well, hey, this is kind of an interesting spot to fish around in general. And unfortunately, our core strategy, well, fortunately, it grew, and we were successful, and it scaled, and we eventually got to about $1 billion. And so we couldn't buy the things that, were in that sort of space anymore. But lo and behold, we had actually a client come in maybe 6-ish years ago and allocate some money dedicated to like a subset strategy. And that was within this microcap space. And, Ben, I think, gravitated towards the Buffett companies over time. And he realized that, like, hey, look, we're in small cap, and it's kind of like a weird self-selection problem where if we find a great business, it grows out of small cap. Right. And so he's like, well, why don't we go a little bit higher, right? Not just concentrate on 3 billion and under. and maybe go up to 10. And so that's kind of how, he's the PM of our small cap plus strategy, which is kind of, that's what he intends to do, is basically take a lot of the work that we do for small cap and grow, let those companies kind of appreciate and grow into, his neighborhood. Right. And then plus he has, a bigger fishing pool to deal with. I kind of went the other way. I'm like, hey, how can I find the craziest, wackiest, like if I say the name of the company, literally me and maybe 7 people in the world know what the hell I'm talking about. So I went that way. But at the same time, kind of applying the lessons that I think both Ben and I learned when we started at Cove in terms of, what is really investable. I think we both arrived at the same conclusion, from maybe like different angles, but it's like, what do I really look for in micro? I don't, there's like 4,000 micros, technically speaking, and 3,920 of them are what we consider the quintessential, like no one gives it, I'm going to cuss. No one gives a shit companies, right? So like if it disappeared tomorrow, like you wouldn't care. Who cares, right? If whatever, I don't know, Abercrombie disappeared, no one cared because there's 10,000 other, clothing retailers and whatnot.
Well,
So
as an investor, you wouldn't care. Maybe some of the businesses might care a little. We got jobs on the line and stuff like that.
True. But in terms of like, is there a reason for this thing to exist, right? And so MicroCap is just littered with these like entities that, for whatever reason happen to be public, but most likely, are subscale or run poorly or just in bad areas and industries. And, I've just learned over time to sift through all that and concentrate on the better ones. And so those better ones actually are interesting because if we can get them at an earlier enough life cycle, right, or before they can maybe hit their stride due to various events or kind of catalysts that emerge, we can grow with them. And, the next step for micro, it actually would graduate into our small cap value strategy. And then obviously, if I wish, we haven't had one yet, but it'll eventually get into Ben's world, right? That's the ultimate success of the 100 bagger. So I mean, I gravitated toward micro because I feel like the ability for someone to hit, the grand slam, forget about the home run, but the grand slam is just a higher likelihood there, right? All else being equal. And certainly it's hard because you are sifting through a lot of crap that, that world is riddled with fraud. It's riddled with people who, failed Chinese reverse mergers, old SPACs that have become defunct, you name it, right? I've come across whatever you can think of, I've probably come across it. But anyway, that's really why I gravitated to it. It's eclectic, lots of oddities, and I think for people who do a lot of diligence like we do, right? We don't invest in 100 different names. We concentrate on our best ideas, and that forces us to actually do work. This like crazy concept in the investment world, where not just read the K and then invest, but read the K, find former employees to talk to, find people that went on to competitors to talk to, really understand how they actually make that marginal dollar, right?
Gotcha.
And do a lot of more work than the typical person in our space. And if you apply that into microland, where there's 1/10 of the number of eyeballs, you can really make outsized returns.
Absolutely. I mean, that's why we exist, right? Is to continue to give a microphone to a space that can provide, there is inefficiency and can provide so much value if you just do a little work,
Sure.
Some work. But, I wanted to go to Ben here on this next question because, clearly you have a coworker here, a colleague who is obsessed with microcaps. I think I'm not being too strong when I say obsessed, and And, I wanted to ask a little bit more on the fund structure side as to how you can participate in some of these kooky, out of the way ideas that, that Eugene might bring to you. Like, oh, this is sub 10 million market cap. Like, let's back up the truck and do this, like how can you do this and participate for where the fund's currently at the level it's at?
Yeah. So we have what I would call concentric circles at Cove Street. And so our core is small cap value. And so that's kind of 3 billion and under market caps. And then I co-manage our SMID strategy, which is $1 billion in market cap to 12 billion. And then we have a microcap strategy, which is, I don't know, basically sub $1 billion, sub 500 million. I mean, depending on, what the opportunity set is. And so Eugene leans more small and I lean more large, but that core is a small cap and we all work on ideas or anything on small cap. So there's a lot of overlap between these strategies. So, what I love about what I love about microcap is that the evergreen opportunity. And there are so many companies that get fewer and fewer eyeballs on them, and the sell side basically abandoned the space. And there's just all kinds of wackiness, whether it's the structure, the physical, where it's located, the ownership structure, the end, kind of small end markets that they're in that no one's paying attention to. There's a never-ending opportunity to be successful. Now, of course, there's the never-ending opportunity to be majorly unsuccessful and lose all your money as well. But so the way I look at it is there's a spectrum of inefficiency in the world. And so if like large cap US value is probably one of the more efficient markets in the world, and African private equity investing is probably on the inefficient scale. Microcap exists on way farther down on the inefficiency scale. And so that leads to opportunities, especially if you're willing to do a fair amount of work. And so as Eugene said, that's exactly what we do. It's almost like there's always something that you can make money on. And if there's in the SMID world, it's more about time arbitrage. It's more about contrarian as opposed to developing an edge, which is, what Eugene spends all of his time digging in these, in these spaces that people aren't looking at, and developing an edge. I would say, we talked a little bit about biomed, before getting on the air. Like, that's a space where Eugene and my colleague Andrew, I think, legitimately have an edge. I've never heard anyone talk about this company. I don't think anybody understands their business model as well as we do. And so, that's how you get, as long as you're willing to hold on to it, that's how you get a multi-bagger. If you find something that's small, look, the law of large numbers basically prohibit me from buying a $10 company and watching it go to 100 billion. Like, that's just, yes, it's possible, very unlikely. But could you see could we see Biomed go from, 300 million, something we own, as I said, something we own Biomed, but could it go much higher and be a 10 bagger over time? Certainly not a guarantee, but could it happen? Yeah, absolutely. And so there's that risk and reward and the just asymmetric upside when you find something, which is why, I would say everyone should have some allocation to microcap. The issue, of course, is you can't scale it, right? You have to be willing to stay small. I mean, Eugene can comment on this, but I'd say 200 million or less, is the most you could actually manage a microcap and still invest in the things you want. And a lot of firms just aren't willing to do that. And so, if you're willing to stay small, if you're willing to stay kind of a boutique asset manager who prides itself on doing a lot of work and will limit its assets and not get to, whatever, $1 billion in microcap, you have the chance to continue to outperform.
Eugene, you want to comment on that? I mean, with every fund manager I've talked to, it's a similar state. I mean, look, we're not breaking any ground. Everybody was listening like, yeah, Bob, we know this. I know, like, we know this. Like, it's, you can only get to a certain point as a fund manager and stay small and focus on the small. But I mean, at a certain point, I mean, who knows? I wonder if that could change or if there's anything that could allow that to change. I don't know. What do you guys think about that? Let's go big picture here. Maybe we can submit this to the governing bodies at some point so that it can help you guys not have to stay small in order to focus on micros. I don't know, Eugene, what do you think?
Look, I think, well, it depends on who you're target audiences in terms of your investor base, right? So, for our small cap value strategy, it's primarily institutional, so it's like 95%. And we have a bucket problem, and this is a message to all the fund managers out there who think that they can break into institutional space because they're doing such cool things. Well, institutions are rigid, and the consultants that they use have very specific mandates. And if you don't fit into a bucket, it's really hard for them to slot you in, even if even if they like your strategy and really believe in it. And so, what we found, like, if you go to the institutions, especially in micro, they're writing $100 million checks or $50 million checks, and they don't want to be 100 or 50% of your strategy, right? So it's very difficult for someone to run a microcap focused fund, and if they want to have allocation to small cap, they don't want to see, $50 billion companies in there, right? Because that's not what they're paying you for. And they don't want to see $20 million companies in there, because then they ask you, well, is that really appropriate for the liquidity profile that we desired? Because we need, these sorts of, like, let's say that they need to redeem tomorrow, right? Because we're not a hedge fund. We have separately managed accounts for the most part. And so, it would be inappropriate for us to stick our clients with like really, really illiquid things that appear in micro. And like I said, we've had the successes that we've had in micro have grown up to be actually, I'll say real companies, but not in a derogatory fashion, but mostly in terms of liquidity and market cap size. So when those have, there are a couple that have become mainstays within the small cap value portfolio, but they originally were micros, right? And those are appropriate for us to hold because, again, they're at a size and liquidity profile that matches our clients' needs. So I don't know on the institutional side if it ever will be the case that someone will allow us to go across the spectrum. That's just not how the business of the investment world has been built. Certainly I think family offices and high net worth individuals don't care, right? I mean, for the most part, they want to make money, right? It's their, they don't, not, sometimes they have their own kind of bucket allocations, but for the most part, if they really like your strategy, you'll get an investor. So, I guess that would be kind of my way to answer that.
Gotcha. All right, Ben, anything you'd like to add, or could we go? I have my next topic teed up, ready to go. But either way, Ben, you want to go? All right,
keep going.
Well, here's the thing, because Ben, when we did our chat last year, one of the reasons we wanted to do another one today and include Eugene is because you were like, Bob, look, Eugene is kind of our main microcap guy, and he's got stories for days. Okay. Not only that, when you guys send me your couple blurbs before this, we got Eugene known as the chief outside the box idea guy here. So that means that, if my math is correct, there's going to be some stories that we can kind of get into today and just kind of shoot the breeze on some fun ideas that people just love hearing about. So I know you guys had a couple stories teed up, ready to go for today. So I think everybody would love to hear about the Bill Miller story. So who wants to give the background and tell that one?
Okay. Wow. All right.
Yeah, Eugene, you didn't know that one was coming. You can blame Ben for that.
Yeah, no, it's wacky in the sense that this was far off, even in the micro world, right? This was like at the time, I think like an $8 million market cap company, and it had, at that time, it was closer to, I'm gonna say, 12 to 13 million in cash, and one of the owners that had about 4 or 5% of the company was a gentleman by the name of Marshall Geller, who we know him from overlapping with him on things like GPX, which is a small cap value core holding, or has been for a long time. And he was like, hey, there's a guy here named Harvey Eisen who owns 30%. I'll round things up. And he doesn't know what to do with this effective. You can almost think of it as a SPAC, right? It was a clean shell called Wish, WISH, and it has some cash, and it has, quote unquote, smart, old school, New York, I don't know, ex heavy hitters, right? Harvey, who ran in like the Warren Buffett crew, for supposedly. And so, we're like, oh, great. Wow, this is kind of wacky. So I, being more entrepreneurial, said, okay, let me see if I can find some private businesses that they could buy, and then we could partner with them by buying a chunk of his ownership. And then all of a sudden wake up with a company that has a real business, some cash, and an operator. And, we could make money, multiples of it just by effectively IPOing something. Well, I don't want to bore everyone with the details, but let's just say that Harvey Eisen is an interesting person that may or may not have, may or may not see the Wish as like a retirement fund or like a 401k for himself, and doesn't really want to do anything. And so we threw all these ideas up, and we're like, hey, why don't we do this with you? Why don't we do that? Like, look at, we introduced him to a couple operators and met with him in New York and blah, blah, blah. And then, said, what, this guy isn't going to do a goddamn thing. So let's force it down his throat. So I started demon dialing. So Wish, let me even back up. Wish was actually a spin out of GP Strategies, something that we own, back like in 1999. And when it was dividended out to shareholders, it maintained, this wacky shareholder base from the year 2000. So fast forward to like 2018, a lot of these people had either passed away or their kids had inherited it. So he owned like 30%, but then the other 70 was split among some very interesting shareholders, such as Phil Frost, as an example, or Michael Price. So he had obvious connections back in the day, and billionaires, for whatever reason, unknown to me still to this day, had shares in this entity. But then there was, the retail probably had closer to 40 to 45%. And I tracked down 3 or 4 blocks, and we started to accumulate, right? And literally, this is me like going on Google, being like, hey, who is, whatever, Bob Smith, and it looks like he lives in Kansas, and literally like stalking people to the point where I'm just like randomly trying phone numbers at Google, saying that this person lives at this address and with this phone number. I'm like, all right, let me see if I can call him. Anyway, track down enough holders so that we could bid them for their shares, and start to get to, I think we got to like 12%. We bought, actually, Mario Gabelli was another guy that had shares, so we bought a chunk of his shares. And then we got to a point where I think we were at like combined like 15. We filed a D, did whatever, just wrote tons of letters, started, saying we're going to run a proxy against him, kick him out, mailing letters to like the grandmas out there, hopefully, like they care or even know how to vote a proxy. But in the meantime, there's a gentleman who actually lives in Dallas that his father had known Harvey from like, the 80s, and had invested with Harvey's investment company. Long story short, they wound up owning like, gosh, I want to say like 16 something percent. It was a really big chunk, and it was split up across like 3 different accounts. And so I finally got a hold of the son, and he's like, oh my God, yes, someone wants to buy this thing. Like, I've been, my dad, he passed away, and I'm trying to see, I was like, he said, I don't want anything to do with this thing. Like, this is my dad's friend. Like, I don't give a shit about this guy. It's like, okay, let me buy your stock. Like, I'm not going to cheat you. I'm going to pay basically, cash value, right? So, and he agreed. And the odd thing was that he didn't know how to get us the certificates. So this is like an old school company where people literally had physical certs. So he had everything within, I think it was Wells, and he couldn't find the certificates, or else we could have just done like, hey, we wire you the cash, you send us the physical cert, and then we take it and we get it notarized. I mean, it's this, which, by the way, I had, because I bought shares personally, and literally from the guy that I bought it from, he had a physical certificate, and I've never seen. I framed it because of something that I don't think I'll ever have again. So anyway, so like we had to cross in the open. Okay, fine, no problem. We're thinking like, sweet, we got it. After this, we will own like a little bit more than Harvey, and in a voting match, let's say we had 2 of the 3 main, billionaires locked up, or at least we thought that they would vote with us. And so, I remember I was actually out of the office and the transaction started happening. And I think we got like 4% done. And then all of a sudden it's like the share stopped. Like the offer was pulled. And the trading, our trader Matt gets a call, and it was the Wells Fargo trading desk, and he was like, "Hey, we can't. We're not trade. We stopped the transaction. So why?" And he's like, "Well, we can't do the trade right now." He's like, "What the fuck does that mean?" And so 5 minutes later, we see the entire block cross. Not with us. Someone had paid a penny more. So what had apparently occurred was that Bill Miller he personally, through I think his family office, had called the Wells Fargo trading desk and said, "Stop this! I'm going to pay a penny more." And because the gentleman who was buying stock from had a private wealth something account with Wells, the fiduciary responsibility was on Wells, and so therefore they had to take the higher bid. And I mean, no one called us to see if we wanted to pay a penny over that. But so Bill Miller literally single-handedly stopped the transaction and then scooped us for a penny. And so we wake up, we're like, of all the things that we could have foreseen, right? The fact that Bill Miller would get out of bed for a $10 million, at that time, it was like probably $10 million market cap company, and put his own capital to work just to block some schmoes from El Segundo. I mean, what? This was the most insane thing. I mean, it was a collection of Billy. It was like a Bill Miller, Joe Muliana, whatever, however saying his name, the guy from TD Ameritrade. What's his name? Phil Frost, Michael Price, Mario Gabelli. I mean, it's the who's who of investors within a $10 million market cap like entity. Like what in the hell is? I couldn't believe this was happening. And so lo and behold, we were basically stuck with that's probably between 15 and 20%. But, us being, we say, look, Harvey, we're going to harass you until you basically greenmail us, because we're still going to run the proxy. And he effectively bought us out because, I think it worked out for us as well, just because for whatever reason, Bill Miller was going to come in and protect Harvey, and maybe we could have won the vote by 1%, because they still didn't have 50 combined. But at the same time, it's like, I don't, then we would be butting heads with Bill Miller, and I don't know. We said, whatever, we'll move on to the next ones. But this is the strangest thing ever, because you would think that 3 billionaires and a couple of 100 millionaire plus folks all within this tiny company that no one's ever heard of. Like, I don't think that's ever happened. But sure enough, that was one of our more wacky ones.
I mean, I'm sure you guys talked about it quite a bit afterwards. I mean, hindsight being 2020, what do you think it was and why this happened? Ben, what do you think?
There's no logic to any of this.
No.
Right? I mean, like anybody who would tell you that like the markets are uniquely efficient and uniformly efficient regardless of your market cap spectrum is just wrong. Like these crazy things happen at the smaller end of the market cap spectrum. I mean, this I think is a very bizarre set of circumstances and characters. Like you could write a book on something like this. But it's kind of emblematic of what you see in this space overall. And it's both an opportunity because, and we do this pretty recently, we do this pretty often where we do a lot of work on a microcap company, smaller microcap company. And you know what, we try to buy it and we realize there is no liquidity. It looks like there's liquidity, but when you try to start buying it, it's not there. So we have our traders, have an order out there for 1 million shares. And every once in a while, you'll just get hit and you have 10 minutes to decide whether you want to do it. And, thankfully we've done the work, and we don't do this with every company, but we do this with things we've done the work on, and then we get hit. And so that's the opportunity where like this can work out in your favor as well. But again, it's one of the risks is that you build this position, Eugene spent all this time, we were going to potentially have control of like a little shell that, we could have done some interesting things with, right? This was our Berkshire Hathaway. Right. And then Bill Miller of all people comes and scoops us. Like it's a moment in my career I'll never forget. Our trader running in and be like, the deal's done. Like we're stopped out. Like someone scooped us. And then later we find out it's like Bill Miller. So for some investors, like this is like a scary story, and it's a reason to stay away from the space. I look at it differently. It's like you just have to be patient. You have to be careful, and you have to realize that there are going to be opportunities that pass you by, and that you're going to spend a lot of time on something that may not pan out because you just can't buy it. And that happens whether Bill Miller steals your shares or whether you just do a bunch of work and liquidity isn't there when you need it to be. So I wouldn't extrapolate and say that there's any rhyme or reason for why this happens, but it is certainly emblematic of how you can just see things that are totally inefficient, totally illogical, and in theory should be opportunities for value investors.
Absolutely.
Yeah.
So, Eugene, sorry.
Yeah, I was going to say, I don't know the lesson learned. My lesson learned is Harvey Eisen had great connections. That's about it. I mean, he still hasn't kind of done a deal with the shell still exists. It's I think they changed the ticker to I wish. And I wish they had actually done something, and he had played ball, and I think we could have done a lot of cool things for him and created value for him because he was the biggest shareholder, and that was the whole thing. Like, I take that back. The one thing I did learn is I don't want to be an activist. I think activism takes so much time, and it's mostly counterproductive because I don't want to yell at Harvey. I didn't want to yell at him. I thought that we could do something in a professional manner that would benefit everybody, right? Because we weren't trying to nickel and dime him for control or whatever. We said, hey, let's do something interesting here. And I think there's a lot of people who go into investments with this idea that, hey, there's something wrong here, and I'm going to be this a great activist and change stuff. I think you are more likely to lose just by having that mindset, because if there's something wrong and you have to do a lot of work to change it, maybe you should, find an easier path to success. And oddly enough, it's not oddly, it's irrespective of whether you go after a $10 million company or $500 million company, the actual cost is the same. And so activism in that world is much more difficult, mainly because from an ROI perspective, it destroys a lot of the reasons for you to even own the stock if you have to sit there for a year God forbid that you don't win the proxy, then you're stuck in something, and people, the management team and board hate your guts, and they're going to be even more entrenched. So anyway, I think that's the lesson that I kind of took away. Like, I don't want to have to do all this crazy, background work and like send letters and harass people. Like, life's too short. I don't want to do that.
Fair enough. Look, hey, activism, it's definitely a different breed, right? And at the end of the day, you have to ask yourself, like, where do I provide value? Where's my value add? Is my value add just continuing to find and look for new opportunities? And, if I see that this might need an activist situation, I might invest alongside an activist that I like, but at the end of the day, it's not going to be me, right? It's a lot of work. I just did an interview with Connor Haley talking about his whole experiences with CLCT and MLabs, and it's a lot of damn work, So, not that you guys don't like doing the work, don't get me wrong, but
Well, I would say
different kind of work.
Yeah, it's certainly it is very time consuming, especially when you have to proxy things and whatnot. But I do want to differentiate though, because we internally believe in this idea of constructivism, right? Where we don't have, let's say that there's a really nice company and they're good returns, good management team. They're not crooks. They're good stewards of capital, but maybe their bench depth isn't quite good, or they need extra oomph on doing diligence on, let's say, deals or helping out with capital allocation or capital markets or some corporate finance stuff. Now, there is a place for bigger shareholders to be constructivists, where they can join the board in a friendly manner and say, look, we're here for the long term. We own 10% of this, and I don't want to change anything about the company. I'm super stoked about the management team, but let me help you and open up some of our kind of back-end assets, maybe even our own connections to folks within your space, maybe that are bigger, to see if we can help you in some other way. And I think that is a much more practical and doable approach. And I think it aligns us with the companies that we own much more so than if we were to be seen as like a threat.
Gotcha. Got it. All right. So Ben, Eugene gave us his weirdest story that he's experienced. I know you guys have experienced a lot of these weird stories together, but from your perspective, what's the weirdest microcap story that you've seen or been a part of, other than this one, of course?
Well, nothing will ever, I think, hopefully never surpass the weirdness of Wish. I mean, I think for me, two of my biggest investment lessons that I've carried with me, since then happened with a microcap company. So I'll briefly describe it, and I'll talk about the two lessons that I learned. So the company is going to remain nameless to protect the innocent, or the guilty, more like the guilty. So this was an apparel licensing company that we were invested in, and we know the management team well. We had a good relationship with management. The company had done really well as the new CEO came in and started expanding the business. The stock did really well, but there was always an issue with the company, and that they had one major retailer was like 20% plus of their sales, and so they'd had like almost a 30-year relationship with this retailer, and so it looked as though the relationship was safe. However, there was some internal changes at this retailer. New CEO came in and basically changed their strategy to, hey, we're not going to license other people's apparel brands anymore. We're going to do it in-house. And so this company lost that relationship. And so the first thing you always want to invest in a business that can take a punch. right? You don't want, and this is one of the, there's a beauty in small and micro, but the risk in small and micro is that you have either customer concentration and market concentration, geographic concentration, so that if one of those things gets hurt, right, either through for losing a customer or through some kind of economic downturn, right, you're scrambling. So in this situation, the company thankfully was profitable enough to survive that hit, but it set the company down a path that basically led to a disaster. So the first lesson I took was invest with a business that doesn't have this binary risk and doesn't have customer concentration and kind of even higher than that, just can take a punch, right? And the difference between this company that we're referencing and a $4 billion company is if a $4 billion company loses a customer, chances are, maybe next quarter's earnings are going to be crappy and the growth over the next year might be hard. But you know what I'm saying? It's never gonna be like a threat to the entity as a whole. And so that event triggered some internal, what do we do next at this company? And what they decided to do was make an acquisition. And so another thing to remember about microcaps is that acquisitions, especially with small companies, can be very time consuming for management, for your employees, right? There's just ask anybody who's done M&A, and there's small deals even a small deal takes up a lot of your time, and can be very expensive, right? There's lawyers' fees and accountant fees, and so all that stuff. And so the company tried to do a very, very complicated deal where they were like transferring IP from Europe, and and I forget all the details, but the financing of it was based on the IP, and it levered them up. And it was a complicated deal with a family who apparently was a motivated seller. And they literally couldn't do it. They just couldn't integrate. They couldn't get they basically, there was some, I would say, fraud in the sense that there were some receivables that didn't show up. And I mean, that deal was set this company off a path that they could not come back from. And so the other thing that I learned is, small companies and small management teams are not necessarily, the best at doing capital allocation changes in M&A transactions. And, even if you have a North Star, which the CEO, for the most part did, he used to hand out copies of The Outsiders to all of his friends. So he had a North Star, but they just couldn't execute. It was too difficult. Maybe, there was some definitely eyes were bigger than your stomach kind of a deal. And they were never able to recover from it. And so, I learned throughout this process an incredible lesson about people and people's motivations, and, what people are trying to really understand what people are capable of, looking back in their history and understanding hey, you were a good operator, you grew the business, you were a good salesperson, but all of a sudden you're trying this really difficult cross-border M&A deal with all of these weird tax issues and an IP transfer and expensive debt. It was too much, right? And so, and we were talking about this at the lunch table today about Biomed, is that, another company the company we reference is they said on their call, we haven't historically done M&A as a part of our growth strategy because they've had such an organic growth strategy. And, it gets a little scary when someone says that, because you just worry that they're going to do the transformative deal that's going to derail all of the success that they've had. So again, Eugene spends a lot more time there, but I will say that I will never forget those two lessons. Make sure that the management team knows what they're doing in terms of actually physically completing a transaction and diligencing a transaction, and then always invest with a business that can take a punch. And I take those lessons with me, in all of my people assessment and all of my business assessment, and even as I'm looking at larger companies.
That's great advice right there. I mean, so, look, for the most part on my pod, Whenever I ask, the biggest investing experience that taught you the most, it tends to be a negative experience or a failed experience. But I mean, have you guys had any kooky, wacky experiences that are like, oh, this worked out? This actually was on the monetary side, it worked out great. Not just, the wealth of knowledge that was gained from that experience, because there's something that can be learned from any experience, right? And especially if you lose, you got those silver linings. But I mean, have you guys had any great wins that started off or just continued to be a wacky weirdo all the way through? And all right, well, this worked out.
Yeah, I actually one that's I literally just had a call with the new CEO of this company. We haven't owned it for 3 years. I just checked in to see what's different about it now, given that its valuation is approaching like stratospheric levels. Anyway, this little company it used to be a little company called Simulations Plus. The ticker is SLP. We don't own it. We used to own it, and I remember this very distinctly. I found it and very rarely will like a B. Riley conference result in anything but me being annoyed at having wasted a couple of days of my life. But B. Riley, they had, whatever, 6 billion little tiny companies go there, and typically it's the same ones kind of recycled, but these guys showed up out of nowhere and I hadn't seen them before. And took a meeting with John DeBella. He was at the time, I think his official title was like VP of sales or something. And so, I sat down with him and started talking about what this company was. And I was like, wait a minute, you're a what? You're a pharma simulation software company that does pharmacokinetic, like absorption simulation trials for like or tests for for any pharma companies that have drug studies coming up. And he's like, yeah. We started talking, and he was an engineer by training and had just been kind of put in a sales role like that year or something like that. And it showed like, being a former engineer, like we're not built to sell. Let's just put it that way. We're not like, I don't know, the engineering mind is not a salesperson's mind most of the time. Anyhow, but I was like, oh, this is kind of fascinating, and went back to the office and did some work. And lo and behold, it was and I kid you not, it was I think at that time they were doing like 14 million in revenue or something like that, but at 40% EBITDA margins. It was the cleanest, like squeaky clean, like steady eddy linear upwards trending growth projection, as if Bernie Madoff had drawn the line, right? I was like, what in the world is this thing? So started calling around, like getting a little bit familiar. Whilst I understand software, like this is a very nuanced piece of software that does a very nuanced thing for a pharmaceutical. And I'm not a pharma person. I'm not a PhD, and I don't know what 99% of the acronyms that they were using were completely foreign to me. So I spent like about 3-4 weeks just reading everything I could on simulations. And lo and behold, San Diego happens to be the home for the AAPS conference, which is for the 3 people that maybe that registered something for. It's like the biomedicals industry's like mecca. So if you're a PhD researcher for any sort of the pharma companies, you go there and you talk about all these things that you're working on. And again, I went there close enough to here. So drove down and went for the day. And besides not understanding, again, 99% of the things that they were talking about, what I did is I went and met randomly like 20 to 30 different PhD, researchers from various companies, Pfizer's, Genentech's, and whoever, right? The big boys were there, and I'll talk to them about like their backgrounds, and eventually got to the question like, who do you use for absorption rate simulations? And I think about 65%, about 2/3, said this little company based here in Lancaster, north of LA. It's like, what? Okay. Immediately, on my phone, like, Jeff, we have to buy this thing like immediately. And, at the time it was, I don't even know if it was like $40 million market cap. It was non-existent. And like I said, we did at that point have one client specifically that had an SMA that allowed us to do these things, right? And we bought a position, and I drove up to Lancaster and met the founder, and Walt. I can't say his last name. It's a Polish last name, so it's like Stolish or something like that. Anyways, and he was this like literally a rocket scientist.
Waltosh, I think it is.
Waltosh, thank you. Well, yes. And so I started talking to him, and he, tells me that he was in the Navy and was in like, I think Air Force, and then he was in the Andrews Air Force Base. At first he was in Alabama designing missile systems, and he did simulations for like missile trajectories and flight paths for missiles. And then he was like, oh, this is kind of like, of course, how he connected these dots. He's like, oh, this is kind of like, the fusion rate of solids into like liquids. And so he started modeling that, and then all of a sudden that's applicable to how your liver or your kidneys, whatever, absorb drugs at some, whatever the technical rate, right? And so parlay that into this little beautiful niche company that was staffed by a bunch of some computer science folks and some ex pharma PhDs, and just steady Eddie kind of bootstrapped it himself, and grew on their own. And just to let it, like, why this was interesting for me is because he had done he'd worn every hat. He was like the CTO, COO, CEO, like the chief salesperson, chief marketing, everything, right? And then he hired this guy John, a young guy, come in, and then I was like, well, Walt, and what's I mean, you've been doing this for 20 years on your own. What's going on? And he's like, well, I think I want to get bigger. And I think there's a real opportunity here. And I realized that, my own shortcomings, that I can't do everything, I can't hold on like this. And for a founder, and this is one of the very most important things, for a founder of a tiny company to tell you that is the catalyst to know that there's something interesting, may or not be good, but interesting happening, because it is a hard thing for entrepreneurs to do, to actually say, like, this baby that I've grown and nurtured, I'm okay kind of maybe like letting go a little bit and trusting people enough to come in and help me make it bigger. And so John was the very first salesperson he's ever had. And so I was like, okay, well, are you going to add more? He's like, yeah, I think I'm going to have like, 2 to 3. Wow. Right. A dedicated salespeople. And on top of that, he did his first ever deal when he bought this beautiful business, Cognigen, out of Buffalo. And I did a bunch of work on them, because at that time we'd actually owned a small cap CRO, Albany Molecular, that was purchased, and they had a very small division that was akin to what these guys were. And what they were effectively a very, very, very high-end group of PhDs, again, that were out contracted with, by big pharma. Like, huge companies would go to them like, hey, we can't solve this problem, can you do it for us? And they're like, oh, sure. And they had this PKB tool that they used internally, and they were users of SLP software. And so it was like a marriage made in heaven, because they were effectively, supposedly they were going to be like the lead gen source. So did his first deal, going back to Ben's point, like, be careful. But he didn't integrate. Like, the thing I liked about it was, like, I asked him, well, what's your integration plan? Doing the typical, like, douchey MBA question. And he looked at me and he's like, I'm just going to let them do what they were doing yesterday. So I was like, okay, well, effectively, I mean, that would work, because it's just like changing the nameplate and be like, okay, you're a different company, but you're doing the exact same thing. And then I think when we were buying it, back in the days when software companies weren't trading for 35x of revenue, I think we were buying it at 8.5% times EBITDA. It was looking back at it, I wish I should have just mortgaged my entire house and bought every share I could. Because lo and behold, within 2 years, John and team, and might I add, by the way, that like their sales technique didn't really improve, other than they actually went to conferences and put up like slides and like billboards, saying like, "Hey, look at us." And then the funny part is, again, being engineers, they thought that was good enough, so they just went back home and just waited by the phones for people to call. But people did call, and organically they started growing 15 and 20%. And all of a sudden, I don't know why or how or when, but someone picked up on this like beautiful little business, and the stock started running. And we wound up selling. We thought we were geniuses. We sold like in the mid 20s. And Walt actually, he stepped back and retired into the executive chairman role, brought in another gentleman that I spoke to last week, and I can't remember his name now. But the new CEO, who came from a competitor called Farside, that had built and sold a very similar business to private equity, and had built and sold a second very similar business also to private equity. And Walt had known him for like 20 odd years. And so he came in and started running this thing, and it just moonshotted to like the 70s. I think at one point, it made me laugh, because this is this little tiny company in Lancaster that I had visited, and that the crack team, which by the way, their offices look like something from they were like a mortgage banker's office, certainly not a biopharma software company. And for these guys to be, worth over $1 billion when I found them when they were like 40, it makes me smile, because Walt is a really, really great person in general. And I'm happy for their success. I kick myself for being the typical value guy and saying like, oh my God, 26 is crazy. Like, who would pay 26 for this? And then watch it go to 72. But anyway, that was a big, that was a big win. And I certainly learned, kind of like the old Buffett-y sort of, find good businesses run by quality people that have a ton of skin in the game, who care about their employees, who care about the direction of the company, the operations of the company, the profitability of the company, focus on free cash flow, all these things. Walt did it not really knowing that, that's kind of like what Buffett heads would look for. And just look for that catalyst to unlock the latent potential. And for that, it was just the catalyst in this case came from him. Like, no one pushed him to do anything. He just one day said, I think I've taken it to as far as I can, and I want to be bigger. And I believe that people care enough about our product, which they did. Certainly my channel checks certified that. And so, I want to be bigger, so I want to hire some interesting folks, maybe do a deal. And that really got the ball going. And, it hasn't stopped rolling for them. I'm super stoked for them. And
that's a great story. Funny you mentioned SLP. That I've actually been trying to get them on for the MicroCap graduation series and talk to Walt, because I haven't followed as closely as you have, but I remember seeing them at a conference, I think at an investor conference. Not AAPS. I don't know if I'd make it to AAPS, but at an investor conference, for the last like 5 years, right? Something like
sure,
that.
Yeah.
They've been in all of them. But we're actually getting close to the end here, because I know we can do 1,000 more stories. You guys are going to come back on and give us some even more. So, I want to kind of close out with some final thoughts. What you guys are seeing, how you guys are approaching MicroCap now, especially from the value perspective. What do you see going on or experienced, let's say, in the last year, and how has that made you think about now moving forward here in 2021? Ben, you want to take that one?
Yeah, I'll start. I think Eugene and I, as Eugene said at the start, we've kind of come to the same conclusion about how to approach investing overall, but in MicroCap through different lenses. And it's about investing in good people, in good businesses, and paying a slight discount to intrinsic value, as opposed to digging for very cheap, maybe not particularly good businesses. So I think we're going to keep doing that. And I will say, there's going to be, hopefully in the next 24 months, an incredible opportunity in microcap, for two reasons. One, there's a lot of SPACs out there right now. There's 300, I think, plus SPACs out there right now who have raised money. There's going to be some that can't do deals. And potentially, there are people who can, whatever, you buy a bunch of stock at 8 and you vote against the deal and you cash in at 10. So there's going to be some of those opportunities for people who are willing to play in the microcap space. But the other thing is, even the SPACs who have completed deals, just reading through the filings from a SPAC, it is just the amount of promotional, just almost out and out, right, like speculation and lying that the SEC allows in their financials versus a proper IPO where you're not allowed to do that, is suggestive to me that there's a lot of hype that is not going to live up to kind of its billing. And so, Bobby, I don't know if you remember, but even a couple of years ago, people were talking about, the public markets are going away. Everyone's going to stay private. The private equity is going to buy up all the companies, and the U.S. public markets are going to be shrinking. And who's going to want to invest there? Well, a couple of things happened. One, the IPO window opened up, and people just hit it as hard as possible, right? And the second thing that's happened is all these SPACs have been raised, and a lot of them have closed deals. So now we have a bunch of new public companies, some of which have been bought by a SPAC, real businesses that just are not going to live up to whatever the hype was. And so the busted SPAC space in microcap, I think, is going to be an awesome, awesome hunting ground. And so we're already starting to keep track of where SPACs are trading, like the ones that have actually made deals, and then the ones that are still waiting to find deals. And those are started to in mass trade below $10. And so there's going to be, I think, dual opportunities in microcap over the next 24 months as the bloom comes off this rose, as it inevitably will, because too much capital flowed into too few opportunities. And so we're excited about that. So that's kind of like a not right now, but just keep an eye on that. And I think microcap is going to be a really fun space to kind of pick through the wreckage of that over the next 2 years.
Very good. Eugene, you want to add to that, or what do you think?
Yeah, I would say that the beauty about micro to me is that it never stops giving. And I know microcap, the indices, Russell, however you want to measure it, it was just a rocket ship upward, but it's not a uniform rocket ship upward, right? And I think the microspace is skewed a lot, but sometimes by odd biopharmas and other stuff that kind of as an ancillary beneficiary of zero interest rates, right? But there's always something to do. There's so much out there, and frankly, there's no institutional coverage anymore. And I'll just add one more little thing for people that are, maybe follow the Russell reconstitution that's happening or will happen, I think, within a month. Russell changed the way that they cut off the 2000. And so a ton of companies over, I think it was 800 or 900, under 250 million market cap are going to get booted. And there's a lot of companies, and again, I encourage people to do this, that are in the 100 to 150 million market cap range that Russell, the indices and ETFs and all this other stuff, they hold not an insignificant amount, right? And I know that a lot of these trades, the hedge funds, whatever, put on early on, but some of these things you can't short, so it's not like the stock has moved down because there's heavy shorting pressure. Is just selling that's happening, and I think it'll provide interesting entry points for some companies that are getting thrown out. And again, going back to what the beauty in microcap is, that no one cares. No one cares about your $100 million market cap company, and that for people that have the capital deployed looking for those opportunities, it provides an interesting a pond to fish in.
Very good. Well, with that, where can our audience go and find more information about both of you guys as well as Cove Street Capital? Ben?
Yeah, so covestreetcapital.com. We're pretty active on our blog. Eugene and I have done a number of podcasts discussing different ideas and our our philosophy and process. So covestreetcapital.com and the thoughts tab is where you're going to find a lot of information from us. I don't think Eugene's on Twitter, but I am. You can follow me at The Inoculated Investor. I took a 6-year hiatus from Twitter and I am back. And I'm enjoying, the interactions that I'm having with people. And so you can see me posting pretty frequently there. And as always, always interested to talk to people who listen to what we say and give us feedback. We're always interested in people who disagree with us or agree with us. So feel free to reach out if you have any comments or questions.
6-year hiatus. Well, before I let you, what brought you back? Missing the action, missing that FinTwit community.
Very briefly, I really wanted to understand the attraction of it. This is what you get with living with my wife is a marketing PhD and she's a behavioral, a specialist on behavioral finance and basically people's behaviors. And she always reads the comments. She doesn't even read articles. She reads the comments because she wants to understand what people are thinking. This was my trying to understand what in the world people are doing, spending all their time on Twitter. And I've been pleasantly surprised. And I think it's because, the quote unquote FinTwit world is very, I don't see a lot of political arguments and Republicans versus Democrats stuff. It's mostly about investing. And so, yeah, I'm sure there's some nasty Twitter battles about things, but I don't see that Twitter trolls and all the things that you hear about when in this mythical Twitter, if you've never used it, all these awful things you hear about, I don't see it. I feel like it's a pretty interesting, thoughtful community. Of course, there's stuff you want to filter out, but you don't have to follow those people. So I found it to be an interesting source of news and an interesting source of new relationships. We actually just got our first client coming from Twitter who followed me on Twitter and listened to me and Eugene on podcast. So it's been an interesting return, and I now take back all the bad things I said about it in the past.
I feel, Ben, I feel you on that. Twitter is my go-to news source now. It's just I'd much rather scroll through Twitter and see what's going on in the world, especially because of FinTwit. Yeah, I love it. You can really get a sense of where the tide is turning that day. It's such a great community, but. We'll save that for the next talk. We'll talk. I've been wanting to do a TIR episode about FinTwit and all the benefits of it, or not, because I think it's pretty interesting. But with that, dudes, I'll let you go. Enjoy the afternoon. We're both on West Coast time, so enjoy. It's a beautiful day. I'll look at us. We're sitting inside. What are we doing? But I really do appreciate you guys taking the time, and I look forward to hearing more stories soon.
Yeah, just inevitably, we're microcap investors, so there will be more stories. That we can promise.
No doubt. Absolutely. Eugene, Ben, always a pleasure, guys. Thank you.
Thanks, Bobby. Appreciate it.
This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.
This episode of the Planet MicroCap Podcast is brought to you by Friedman LLP, a top 40 global accounting, tax, and business consulting and advisory firm, providing a full spectrum of services for public and private companies since 1924. Contact Friedman when you will need to raise capital and adhere to U.S. standards. The Friedman partners will work diligently with you to provide the financial assurance, regulatory, and transactional services you need. When the stakes are highest, Friedman makes sure you are well equipped. For more information and to get a Friedman free consultation, please call 856-830-1660 or email Neil Levine at nlevine@friedmanllp.com. Again, for more information and a free consultation, call 856-830-1660. 1660 or email Neil Levine at NLEVINE@friedmanllp.com.